Welcome back to the Better Lives podcast. I'm your host, Kaitlin.
And I'm Michelle.
And we are talking about something super current today, home refinancing. You might have seen that rates are beginning to drop, and you might be considering refinancing your home if you originally got a pretty high rate. But before you do, we wanted to bring in Sue, a mortgage loan originator at Central Willamette Credit Union, to break down when it makes sense to refinance and when it doesn't. Sue, thanks for joining us.
Thank you. It's great to be here.
We're so excited. We recently had Alex here, and he talked a little bit about, what they really mean and the different types of mortgages. And so we're excited to go into the interest rate portion. So let's start with a big question. What does refinancing actually mean?
Refinancing is where you are going to change the terms of your loan, usually to better yourself, either with a lower rate, shorter payments perhaps, or even longer payments to give you a lower payment per month.
And so do you find that for a lot of people refinancing does make sense, or are there times when it doesn't make sense?
There are times when it doesn't make sense, and that is when the cost to refinance is outweighing the benefit. Because if you're not going to be in the home long enough to recoup your fees, it doesn't really make sense to refinance. But other times, if you are refinancing, let's say, to eliminate debt, to lower your monthly payments, that's absolutely a good thing to do. Now, there are times when you need to look at the whole situation because credit cards can be as high as 30%. Need to look at your bill and see what they're charging you on that rate, because 30% compared to 6.5%, 7%, you're still gaining, even though the interest rate could appear to be higher.
So you have people sometimes start with a lower rate and then refinance to a higher rate just to pay off debt?
Yes.
So how does that work? Are they using the money that they're saving to pay off debt, or are they getting money back when they refinance?
They're using the equity in their home. And so typically what we'll do is we'll get their bills that they want to consolidate, and then we pay them at closing so that the money goes towards what they're trying to consolidate, and it doesn't go into their hands necessarily.
Nice.
Where they can spend it before they get a chance to
be
do
me.
what they plan.
Yeah.
That would be me, yes.
Kind
So
of
that's
off topic,
awesome.
but I find that people that do like debt consolidation loans to pay off their credit cards or whatever, they'll take out the loan, pay off the credit cards, and then spend on them again, and it kind of snowballs the problem, and right, you have your loan now and the credit cards. Is that something that people find that happens with the refinances?
It can happen. We don't necessarily require that they close out the account. They are, after all, responsible adults. But we do try and counsel them as we go through the process. I actually had a borrower that I paid off 22 credit cards.
Wow.
They were $1,000, $2,000 balances, but they all added up. And so we did a full refinance. I took them from a 3% interest rate to about 7.5%.
Wow.
And it totally made sense. He still saved almost $1,000 a month because of the fact that we paid off those little debts.
And so in that case, did you pay it off at closing?
Yes.
Nice.
And he was more than happy to do that.
Yes, I think that's really a great idea for people who don't have necessarily the what do you call it when you the persistence or the
self-control,
the discipline. Yes, thank you. Because I think that's something that holds me back from like doing a debt consolidation. It's like, am I really that self-disciplined to do that?
When I was 20, I took out a loan to pay off my credit cards, and then I ended up spending on the credit cards again, like I was talking about. So,
and had the loan on top of it.
Right. So the loan payment was like $400 a month, which was manageable until I spent $10,000 on credit cards again. So.
So when you meet with somebody who's interested in refinancing, the goals of the refinance is something that you talk about with them.
Absolutely. And I'm working on a file right now where we're refinancing because he is buying out, or the ex-spouse is buying him out. And so actually she's the one refinancing. And, you know, in that situation, it's like I have to, because they need to pull the equity out of the home. There could be other reasons to refinance as well. Sometimes you need to, it's removing a co-borrower or perhaps adding in a new borrower so that they're entitled. And so those are things that you do discuss and try to pick the program that's going to be the most beneficial for them.
So do you find that, what do you find is like the most common reason people refinance? Is it to save money on the loan itself? Is it to pay off debt?
It's kind of both. If the rates are low, it's absolutely to lower the rate. If rates are not low, I have another person that's just contacted me, and she has a medical bill that is substantial. There's not any other way for her to pay for that, so she's using the equity in her home. I mean, it's like a $200,000 bill.
Wow, that's a hard decision to make.
Yeah. So then you look at what assets do I have that could cover that and protect me financially, because they could garnish income or, you know, force a lien on your home.
Right.
So better to be proactive in that regard.
Wow.
And so is the process of getting a refinance the same as getting a mortgage?
The process is exactly the same. So you just submit an application, we verify income and assets, and run it through our evaluation just like we do on a regular purchase.
And there's like appraisals and all that
Oh
stuff
man,
again?
yes. It's so hard. We did ours, and the lady came out and she's like, you need to fix this and this and this and this, and then I'll give you your appraisal. And so
Wow.
I think it was less time to close on our refi than it was to buy the house, but it certainly was not an easy process. It was worth it, though. I don't regret doing it, and I would do it again if rates dropped a little bit lower.
Yeah. And sometimes when we're doing a refinance, because let's say rates have dropped, but equities have improved and you're not necessarily needing to draw cash out, then we may get an appraisal waiver.
Oh, that's interesting.
Because there's enough equity that's demonstrated out in the market to support what your tax bill gives you. And so then we may not need an appraisal. But most likely, if you're pulling cash out, almost always need an appraisal.
And then you also pay closing costs again, right, when you refinance?
You do. And that's because we're basically creating a brand new loan. So we're having to re-verify everything, use all the third parties that we used before for title, appraisal, credit bureaus, certificates for like flood insurance. All of that has to be done all over again. So the difference is that on a refinance, we can include those costs in your loan, whereas on a purchase, you pay those over and above down payment.
Yeah,
So-
there's no down payment.
Yeah, that's interesting. So yeah, no down payment, but the closing costs can be rolled in. So when
Right.
people talk about a no closing cost refinance, it doesn't really mean no closing costs. It just means they're rolled in.
Not necessarily, because there are some lenders out there that, for whatever reason, are basically eating those costs, or they're building them into something else, perhaps into an interest rate. There are different things they can do to be creative, so it comes across as no closing costs. I'd be wary of that, because somewhere along the line, somebody is paying, because there's really nothing for free.
Nothing is free. So,
But
true.
sometimes the lender will absorb those costs because it's just built into their system to do that.
Can you tell us about why refinancing with Central Willamette Credit Union is a good choice for buyers?
It's a great choice for buyers, and I can tell you from all kinds of experience outside of this company as well as inside that we are very competitive when it comes to rates. We are all about our members and wanting to give you the very best because we care about you. You are like family to us, and you're an owner of this company as well. And so we want to make sure you're educated to make the right decision, that it's going to better you, because after all, we are in this to be better. And it's just a great opportunity to work together to extend your membership, to cover more areas and make it easier on you all the way around.
So our listeners should come see you to refi.
Yes, for sure, because I do educate my members to understand the process, to understand why it does make sense or why it doesn't make sense. Because sometimes I've had to tell people I would wait. I don't think it's the right time.
Oh, and I think that's so valuable because I talked to so many lenders when I was looking for my home that didn't really talk about that. It was just like, oh, yes, do it now, do it now. Yeah. But sometimes it really isn't beneficial. And so it's great that you're honest.
Yes, exactly. And we're not, after just trying to make a sale. We're here because we do care about each member. Yes, it helps us. But at the same time, we want that long-term relationship.
Yeah, I think that's the one thing that's great about you and Alex, I call you guys the mortgage experts, because it's not about just making that deal. It's about finding out where each person is and what their goals are and what they're trying to accomplish. And you really help them plan for that and figuring out the best solution for their needs. And I think that's a differential that is not experienced with other companies.
Right.
That's awesome.
So one last question I did have, and it was on the sheet here, but I forgot. I'm wondering, so let's say somebody has paid off like 25 years of their home loan and they might have, a higher rate. In those cases, would it make sense to just pay off the rest of the loan, or can refinancing still have a benefit?
That's a good question. It depends kind of on their situation. Are they able to afford the payment they currently have? Sometimes what we can do is we look at shorter terms so that they're getting still a great rate, but maybe they don't need it for long term. I've had people who've owned their homes free and clear, and then they come in and get a mortgage on it.
You can do that?
Oh, yeah. And so it's just a cash out refinance, and we go into a new first mortgage. So depending on where they're at, for example, on a refinance, it could be that you could get the very same payment as what you had on a 30-year, but it's only a 15-year. Now, if you're down to 5 years left on your loan, we're going to have a discussion because we want to know what is your goal, what is your purpose. You might be better served if you're trying to pull some additional cash out to go with a different vehicle, like a home equity loan, and leave that first mortgage in place. Kind of depends on the rate, what your payments are, and whether how comfortable you are with that payment, because some people just, they're in retirement. They don't want to pay everything towards a mortgage. Yeah. And there's really no reason to. You can pay as long as you are comfortable paying.
Absolutely. I heard an idea about a 50-year mortgage floating around.
Yes.
And I think that I want to talk about that just because while the payments will be a little bit lower, what I was looking at showed that they're not that much lower and you pay so much more interest.
Yes. So on the 50-year mortgages, I used to say we need to have longer-term loans to make those payments affordable. And yes, that is a result of the longer term. But on the back side of it, you will pay a whole lot more in interest over the full term. Now, what you have to consider, how long are you going to be in that house? How many people really live in their house for 30 years?
And I guess most people don't.
No. They're moving 2 to 5 years usually, and especially if you're a first-time home buyer, because you're not buying your forever home right up front. So if you get into a 50-year mortgage and makes it affordable, you're able to get in, that's fine. Now, what you also have to remember is that most of the interest you pay in your payment is in the early years of your mortgage. So therefore, not as much is going to the principal. So that means your balance isn't paying down. And so as your home grows in value, your loan does not go down as quickly.
So you're gaining equity slower.
Yes. And so when you go to sell, you're not going to net out as much as you would have otherwise. So you really have to explore both sides of the coin.
Interesting. Well, I just want to thank you so much for joining us today. I learned so much. I'm sure you did too, Michelle. It's just such a benefit to have people like you on the team that we can just bring in and educate with. And it's just so awesome.
Well, thank you so much. It was great fun.
I'm glad you had a good time. You can find us on Instagram and Facebook at Central WCU. And if you check out our website, we have a podcast page there. You can send in any feedback you might have. And please join us next time so we can keep building better lives together. Thank you.
Thank you.
Thank you.
The information provided here is for informational purposes only and does not constitute financial advice. Consult with a qualified financial advisor before making any financial decisions.